Oil is surging, gold is volatile, and the US dollar is strengthening, all at the same time. Which raises one of the most important questions investors are asking right now. If geopolitical tensions escalate further, who actually wins? Oil, gold, or the dollar? Because the world is entering a period where economics and geopolitics are becoming inseparable. War risks are rising. Energy supply routes are under threat. Welcome back to John Forecast, where we decode the macro forces behind the gold, silver, and global market moves. Central banks are navigating inflation pressures, and global markets are reacting in real time. In fact, recent tensions in the Middle East have already sent oil prices above 90 per barrel, while markets brace for further disruption. Some analysts even warn crude could surge toward $120 or higher if the conflict continues. And when oil moves like that, the ripple effects spread across the entire financial system. Inflation expectations rise. Bond yields react. The dollar strengthens. Gold becomes a safe haven. But here's where things get complicated. Sometimes all three assets rise together. Other times, they move in completely opposite directions. So in today's video, we're breaking down why oil reacts first to geopolitical escalation, why gold sometimes rises and sometimes doesn't, why the US dollar often becomes the ultimate winner, how inflation, interest rates, and energy markets interact, and what investors should watch next. Because if global tensions continue rising, the battle between oil, gold, and the dollar may define the next phase of global markets. Why oil is always the first to react. Whenever geopolitical tensions rise, oil is usually the first market to move. That's because energy supply chains are extremely sensitive to conflict. A single disruption can affect millions of barrels per day. And right now, one of the most important choke points in the global energy system is at risk: the Strait of Hormuz. This narrow shipping route handles roughly 20% of the world's oil supply. If shipments through this region are disrupted, global energy markets react immediately. Even the possibility of disruption is enough to send prices higher. That's exactly what we're seeing now. Recent geopolitical escalation has already pushed crude oil sharply higher in volatile trading sessions. And if tensions intensify, energy markets could face even bigger shocks. Here's something most people don't realize. Oil doesn't need an actual supply disruption to surge. It only needs the fear of one. Markets price risk long before reality arrives. Why oil spikes? Trigger: global inflation. When oil prices rise sharply, the entire global economy feels it. Energy is embedded in almost every industry: transportation, manufacturing, agriculture, logistics. And when energy costs increase, those costs spread through the supply chain. This eventually shows up in inflation data. Gasoline prices rise, shipping costs rise, food prices rise, and suddenly, inflation expectations move higher again. That creates a serious challenge for central banks, because inflation is the enemy of economic stability. The Federal Reserve's dilemma. If oil spikes and inflation rises again, central banks face a difficult choice: cut interest rates to support growth, or keep policy tight to control inflation. This is where the Federal Reserve becomes central to the entire equation. Higher inflation expectations often push bond yields higher, and when yields rise, the US dollar usually strengthens. This creates an interesting chain reaction. Oil goes up, inflation fears rise, yields increase, dollar strengthens. But here's the twist. A stronger dollar can sometimes limit how much gold rises. Gold's safe haven role. Gold has long been considered a safe haven asset. When markets become uncertain, investors often shift capital into gold. Recent geopolitical tensions have pushed gold toward record territory as investors seek protection. But gold's behavior during crises is not always straightforward. Sometimes gold surges dramatically. Other times it struggles to maintain momentum. Why? Because gold is extremely sensitive to real interest rates. If bond yields rise faster than inflation expectations, gold can face pressure. And that's exactly what sometimes happens during energy-driven inflation shocks. Let's pause for a moment. Imagine oil surging toward $120. Inflation spikes, bond yields rise, the dollar strengthens. Does gold still rally? Sometimes yes, sometimes no. That's why understanding the relationship between these three assets is so important: the dollar's hidden power. The US dollar often becomes the quiet winner during global crises. Why? Because it's the world's reserve currency. When uncertainty rises, Global investors seek liquidity and safety, and the dollar offers both. Even during geopolitical stress, a stronger dollar can limit gains in commodities like gold. In fact, during recent market moves, gold struggled despite geopolitical tensions because the dollar and treasury yields strengthened simultaneously. This dynamic creates one of the most fascinating relationships in global finance. Oil, inflation, higher yields, stronger dollar. And sometimes that stronger dollar becomes the dominant force in markets. When oil, gold, and the dollar rise together. But there are rare moments when all three assets rise at the same time. This usually happens when markets fear stagflation. Stagflation is one of the most dangerous economic environments. Slow growth, high inflation, energy shocks, financial instability. During stagflation, oil rises because supply shocks push prices higher. Gold rises because investors seek protection from inflation. The dollar rises because global capital seeks safety. These environments are rare, but when they occur, markets become extremely volatile. Historical lessons. History offers some important clues. During the oil shocks of the 1970s, oil surged dramatically, inflation exploded, gold prices soared, the dollar experienced extreme volatility. That era became one of the most turbulent financial periods of the 20th century. Today's environment isn't identical, but some similarities are emerging. Energy supply concerns, rising geopolitical tensions, inflation uncertainty, and shifting global alliances. Geopolitics is driving markets more than economics. One of the biggest changes in global markets over the past decade is the growing influence of geopolitics. Trade wars, energy conflicts, sanctions, supply chain disruptions. These events increasingly shape financial markets. In fact, analysts say geopolitical risk has become one of the most important drivers of commodity prices in 2026. And when geopolitics drives markets, volatility tends to rise. Here's the big takeaway. Markets are no longer reacting only to economic data. They are reacting to politics, diplomacy, and military developments. That's a completely different type of market environment. What happens if tensions escalate? Further, let's explore a few scenarios. Scenario 1, conflict escalates and energy infrastructure is disrupted. Oil surges above $100. Inflation expectations rise. Bond yields increase. The dollar strengthens. Gold rises moderately. Scenario 2, conflict escalates, but central banks signal rate cuts to protect growth. Oil rises. Gold surges dramatically. The dollar weakens. Risk assets become volatile. Scenario 3, conflict spreads globally and financial markets panic. Oil spikes. Gold surges. The dollar skyrockets as global capital seeks safety. This is the most extreme scenario, but markets must consider it. But smart investors are watching. Instead of reacting emotionally to headlines, professional investors watch specific signals. Energy supply routes, shipping traffic through key choke points, central bank statements, bond market reactions, currency movements. These indicators often reveal where markets are heading before headlines do. Oil, gold, and the US dollar are three of the most powerful forces in global markets. And right now, they are all responding to the same underlying driver, geopolitics. Oil reflects energy supply risk. Gold reflects financial uncertainty. The dollar reflects global liquidity demand. Which one wins ultimately depends on how the macro environment evolves. If inflation dominates, gold could outperform. If liquidity dominates, the dollar could win. If supply shocks dominate, oil may lead. But one thing is certain. If geopolitical tensions continue escalating, these three assets will remain at the center of global markets. Now I want to hear from you. If geopolitical tensions escalate further, which asset do you think will win? Oil, gold, or the US dollar? Comment below. And if you want deeper insights into commodities, inflation, and global markets, make sure to subscribe. Because in today's world, understanding the intersection of geopolitics and finance isn't optional anymore. It's essential.